The S&P 500's valuation just hit a level we haven't seen since the dot-com bubble, a Shiller CAPE ratio approaching 40, more than double the historical average. But here's the twist. 72% of Americans say the economy is bad. The stock market says we're richer than ever. The public says we're broke. Both can't be right unless the market no longer measures what you think it does. Today, we're connecting Wall Street's most dangerous number to $5. 8 billion crypto time bomb that nobody's talking about. And the fuse is already lit. Think of the stock market like a thermometer. For decades, when it went up, it meant the economy was heating up. More jobs, more spending, more opportunity. But what happens when the thermometer reads 104 degrees and the patient says they're freezing? That's America in March 2026. The S&P 500 is trading at nearly 40 times cyclically adjusted earnings. The last time we saw this number, right before the dot-com crash wiped out $5 trillion in wealth. Meanwhile, a February 2026 Pew Research survey found that nearly 3 out of 4 Americans view the economy negatively, and 40% believe things will get even worse. These two data points shouldn't coexist. But here's where the story takes a turn nobody expected. The obvious take is simple. The market is in a bubble, a crash is coming, sell everything. Pundits have been screaming this for months. Others say sentiment is a contrarian indicator. When everyone's afraid, that's the time to buy. Both sides are missing the point entirely. The CAPE ratio isn't just high. It's high in a way that's structurally different from every previous bubble. And that difference explains why Americans feel poor while the market screams rich. So what's really going on? Here's what neither the bulls nor the bears are telling you. The S&P 500 isn't the economy anymore. It's a mirror reflecting about 7 companies. The Magnificent 7 tech stocks account for roughly 30% of the entire index. When NVIDIA's stock doubles on AI hype, it drags the whole S&P 500 upward, making it look like the market is booming. But strip out those 7 names, and the remaining 493 stocks, barely moving, flat, some declining. This is why the CAPE ratio can sit at 40 while 72% of Americans feel left behind, because they are. The average American's wealth isn't in NVIDIA or Microsoft. It's in their home, their car, their paycheck. And housing affordability just hit a 40-year low. Real wages, adjusted for inflation, have grown less than 1% since 2024. The market isn't lying. The people aren't lying. They're just measuring completely different things. It's like 2 people looking at the same sky, one through a telescope pointed at the sun, the other through a window during a rainstorm. Same sky, totally different weather reports. But that's only half the story. Now let's connect this to something happening in crypto that makes the picture far more disturbing. In March 2026, approximately $8 billion worth of crypto tokens will be unlocked, meaning early investors and project insiders can finally sell. That's nearly 3 times the monthly average. The biggest unlock, Rain token, at $338 million. Then Aster at $56 million, Sui at $48 million, Layer 0 at $45 million. Here's what you need to understand. These tokens were purchased by venture capitalists and insiders during the 2021 and 2022 crypto bull run, often at prices pennies on the dollar compared to today. When the vesting period ends, they sell. And when $8 billion of insider money hits the exits in a single month, who's on the other side of that trade? Retail investors, regular people, the same people who already feel the economy is terrible. This is the same playbook from the dot-com era. In 1999 and 2000, IPO lockup expirations flooded the market with insider shares. Companies like Pets.com and Webvan saw their stock crater not because the businesses suddenly got worse, but because the people who built them were legally allowed to cash out, and they did. The CAPE ratio was at 44 then. It's at 40 now. The insiders are cashing out again. Different asset class, same mechanics, same ending. And here's the data that should make you sit up straight. While the S&P 500 has been flat in 2026, the MSCI World ex-US Index is up 8%. International markets are outperforming America by a historic margin. Smart money isn't just leaving crypto. It's leaving the entire US market. The rotation has already begun, and most people haven't noticed. So what does this mean for you, the person watching this who isn't a hedge fund manager or a crypto VC? It means the traditional playbook of invest in the S&P 500 and forget about it might be a trap right now. You're not buying the American economy. You're buying a concentrated bet on 7 AI companies at .com era valuations. Meanwhile, $8 billion in crypto supply is about to hit a market already drowning in fear. Bitcoin's Fear and Greed Index has been stuck in extreme fear for 3 consecutive weeks. Standard Chartered just slashed their Bitcoin year-end target to $50,000. Ask yourself this: if the insiders are selling, why are you buying? Here's the prediction that might sound extreme today but could look obvious in 6 months. We're watching the early stages of a generational capital rotation out of the United States. The CAPE ratio, the sentiment gap, the token unlocks, the outperformance of international markets, these aren't separate stories. They're chapters in the same book. The question isn't whether a correction is coming. It's whether America's 2-decade monopoly on global capital is ending. Drop a comment below. Do you think the US market still deserves its premium? Or is the era of American exceptionalism in markets finally over?